spread opportunities that a lot of people could be trading. And there's not just one, there's many across many different markets, of course. And spreads like copper, gold, bonds, oil, gold, silver, S&P, NASDAQ, crack spread against the refiners, which obviously is a correlated spread, knob spread, fob spread, tuts and fights. We can obviously play these to turn them into what? Fly trades, outrights, copper hedge trades against pretty much anything else. And the trade that we've just made a fortune on there, a big fortune on there, was the pound dollar PF carry trade. Oh yes, the pound dollar PF carry trade. Did we call it in advance? Yes, we did actually. You might find it surprisingly interesting to note with 12 enormous likes that we did have it in advance. You can see at 10:15 a.m. this morning, you'll see that we put the GMF cable PF long back on the bid watch. So the PF long is going back on the bid watch. Well, if it's a PF long, that's a short cable trade, correct? And that was at 10:15. 10:15. So if you look at the trade, 10:15 is when the tweet went out. This trade here is 10:15, see it? It's not actually 10:15, it's 10:20 because it's a 5-minute candle, right? So this trade took place at 20 past 10, 5 minutes after the tweet went out. And it was a buy PF line. When a buy PF line means a sell on cable. Well, cable hadn't quite ran the stops. We waited for cable to run the stops and we added to the cable sell trade. We'd already bought this as a buy trade for the blue line. And if we bought the blue line, what we're doing is we're buying the S&P. What we're doing is we're selling the FTSE. And you can see that the blue line, the bubble did not compress. I was talking about this morning. The bubble didn't compress. And I said, all I care about is that bubble needs to burst. Well, the bubble finally burst. The pound dropped, the PF line exploded, and we're now making a triple alpha profit on that as a deal. Triple alpha profit. Simply by just following the tweet, doing the business that's required, making sure the pricing's right, and following in with the ratios, and we make a triple alpha on this one. A perfect example of perfect a trade. That's a perfect spread, isn't it, on this occasion? It's a perfect spread outcome. So made a lot of money on that. Best trade of the day so far for me as far as money. And fabulous, absolutely fabulous. So obviously one of the other spreads we talked about, because we're obviously in the discussion about spreads, is we were asked, I know Paul's very interested in the crack spread, so I thought we'd bring the crack spread along for your interest. And this is the crack spread here. And when you look at the crack spread, this is actually the full crack spread. So what do we mean the full crack spread? Well, we've got the small crack spread, which is obviously RBOB against heating, RBOB against oil, or you've got the full crack spread, which is a 3-2-1 crack spread. So you've got 3 oil, 2 RBOB, 1 heating oil. This is the full crack spread. It's on a gap chart so that we get these cash opens, because we're obviously comparing it to products like Crack and Phillips and some of the refiners like that. And the idea is, of course, that the difference between this crack spread and the other crack spread is simply heating oil prices. So if I know that the difference is heating oil, by comparing these two spreads, we get directionality in the crack spread, but then that gives us a directionality in the product. We also get value. So we get two things. It's very much like the bonds. We get directionality and value by comparing the two spreads. So take a look. You'll probably already be able to see some of these very obvious trade ideas. There's a very obvious premium at that stage. There's a very obvious premium at that stage. There seems to be a bit of a discount developing into this stage. There seems to be a very obvious premium at that stage. You see how easy it is to spot these? You see how crystal clear it is to spot these elements? There's a very obvious premium at that stage. Very obvious. Could argue that there was a probable discount developing into this. You can see that that's hardly moving. This is down by quite a sizable amount. So there's probably a good discount into that candle to trade into. So what's the difference between them? Heating oil. That's all the difference is heating oil. So when you look at heating oil, you're able to start recognizing those spread differences. We recognized that there was a premium up here, so we could start selling some heating oil. Heating oil is now the red line. Massive profits on heating oil. Heating oil is now discounted in here. Massive rally in heating oil. Heating oil is now premiumed in here. Probably the best one and easiest one to see. Heating oil collapsed in price, and then heating oil is actually discounted here. You know, see that? That's discounted. So that's going to be a buy trade in heating oil, even on the way up there. And then we get a sell on heating oil there, and heating oil's rolled back down. 100% winners trading heating oil. 100% winners. So when we look at these 100% winners, what else have we got? Well, it's not just about the heating oil, you know, because obviously heating oil is an outright. We're trading an outright based on spreads. So you can argue that it's a spread. You can argue it's not a spread. And this is quite an awkward debate, isn't it? Is the heating oil a spread? Well, technically, no. The spread would actually be to look at these two products and say, well, they're positively correlated, right? Well, how can heating oil be a spread, Paul? That's why I mean it's an awkward debate, right? How can heating oil be a spread? It's an outright, just the same way as oil's an outright, just the same as RBOB's an outright. So how can heating oil as a standalone product be a spread trade? It is a really awkward debate, isn't it? But the interesting thing is, if we can argue that heating oil can't be a spread because it is an outright, well, how do we explain this? Because it's quite clear that if I just gave you these two lines and I said to you, can you spread these two lines? And it doesn't matter what the two lines are. If I asked you the real money question, can you spread these two lines? What's the answer? Can you spread those two lines? Yeah, because the spread trades should be relatively straightforward. The spread trade would mean that on that green candle, for example, let's do this one here, because this is obviously the clearest and easiest one to spot because there's a gap in it. If that is a spread trade, you'd sell that, wouldn't you? But you wouldn't just sell that, you'd buy this, agreed? And that's what your spread is. So the question that we're asking again is, can you spread this chart? And the answer is yes. With a very high degree of certainty, I can absolutely spread this chart. But the difference between these two products is just a heating oil product, isn't it? So when we talk about spread trading, what we're actually talking about is R-squared outright trading. So if I sell the candles and I buy the black line, I'm basically short a single contract of heating oil. I'm just short a single contract of heating oil. Because this contract here has RBOB, heating oil, and oil. And this contract has RBOB and oil. So when we sell this and we buy this, what we're left with is a short sell on heating oil. So we can obviously look at that and say, well, it's a short sell on heating oil. Let's get busy with it. You get short selling the heating oil product and you make this trade that lasts for days. And you make a fortune. And you make a fortune. So all of a sudden, spread trading can be now converted into outright trades. Well, that's what R-squared trading is converting spread trades into outright. That's what Charlie D did. You know, Charlie D looks up at the Japanese yen on the big board, sees that the bond is discounted, and then buys the bond. And effectively, he would normally, in a spread environment, have sold the Japanese yen, wouldn't he? But he doesn't sell the Japanese yen. He's making an assumption, perhaps, that the Japanese yen is going to hold on to the bid, and therefore the edge is in the bond. But how can he verify that that's the case? He sees Goldman Sachs buying bonds. He sees the 10-year Treasury notes starting to rise. And all of a sudden, his bond now looks like an absolute no-brainer opportunity to get long bonds into. And all of a sudden, everything becomes very, very sensible. Every trade he now takes is now the right trade to be on. And I think that's obviously something that we have to start recognizing about trading. So when we look at these ideas, all we're doing is trying to figure out how we can express these trades as outcomes. Now, the interesting thing is that when you look at this, this looks like a very close +1. When you start adding refiners into this, like the crack spread, for example, here, you'll see that the crack spread seems to be slightly disconnected to the crack spread. Now, the reason for that is the crack is not to do with the crack, believe it or not. It's not to do with this spread here, it's to do with the refiners that trade this spread. So when you look at ticker symbol CRAK, this ticker symbol CRAK is very much like this refiners themselves, like Phillips, for example. If you look at the crack spread and if you look at Phillips, you'll see that the crack spread plus Phillips look very, very simply positively correlated. So you'll be able to recognize that there's opportunities to trade Phillips or the crack spread against the underlying crack spread. And you can see that if we saw that trade there, you can see that this looks way overpriced on crack. Way overpriced on crack. So because it's way overpriced on crack, you can take advantage of that by simply selling crack spreads. Selling ticker symbol CRAK if you want to take advantage of that crack spread short. Crazy outcomes. And high probability outcomes as well. So we've got a lot of different ways to dice this. And in fact, the challenge that we've sometimes got is we've got too many ways to dice it. And it gives you too many options. And I think that's one of the problems we've got in this room is that you actually have too many ways to be able to make money. You know, everybody else gives you one way and hopefully, fingers crossed, touch wood, that it makes you money. We give you too many ways to make money. You can make money by trading the order flow setups on their own. You can make money by trading the RGLs on their own. You can make money by trading the RGLs with the interns exercises on their own, spring trades with the RGLs on their own. You can make money trading any of these elements on their own, or you can make money trading outright. So you can make money trading spreads, or you can make money trading blah, blah, blahs. And there's so many options. That's why we call it a benchmarking process. We build all of those ways of making money into a single trade. So there's got to be a dealer's auction. There's got to be a value. There's got to be a key level. There's got to be the story building to make the dealer spread sensible. And therefore, when we can explain the dealer spread, when we can explain the dealer's auction, we execute. And we have a way of doing that. We have a lot of ways of being able to do that. We can lean. We can passively offer into a trade, passively bid into a trade. We can lean into it after an absorption. We can take the Heisman trade regardless. We can then take the tipping price trade. We can then take the BSG squeeze trade. And then we can take the breakout trade if we were so inclined. A lot of ways to make money out of every single trade we take. Sometimes it might be too many ways, but I'd rather give you too many than too little, because that way you're then able to build the type of trade that you want to do business with, the type of trade that you're comfortable with. So spread trades, absolutely. All of these are possible spreads.